Good afternoon. Thank you for joining us for this webinar, Tax Accounting 101 for Technology Startups. I'm your moderator, Renee Goodenough from the New York Small Business Development Center. I'm going to go through a few housekeeping items while folks jump on. Also from the New York SBDC on camera, we have Greg Callender from the Pace SBDC and Andrew Flam, Regional Director of the Pace SBDC. And behind the scenes for us is Jenny Alton from our central office. And then we have a full crew from Shay CPA today. Please type any questions in the GoToWebinar questions box as they come up. Questions we are not able to answer during the Q&A and questions that are more technical and may take some time to respond to, we'll take offline for the Pace SBDC team to follow up on. If you submit a question, we will not mention your last name or your business name unless you reference them in your question. Today's host is the Pace SBDC. They are part of the New York SBDC network of 22 campus-based centers and outreach offices located across New York State. The New York SBDC is the U.S. Small Business Administration resource partner. Our free services, like this webinar, are made possible by funding from the SBA, New York State, and our host campuses. Joining us to lead things off and to introduce our presenters is Pace SBDC Director Andrew Flam. Andrew, I'll turn things over to you.
Great. Thanks so much, Renee, and good afternoon, everyone. Thank you so much for joining us. I'm really looking forward to today's session, and we'll jump right into that in just a moment. Very quickly, my name is Andrew Flam, as Renee mentioned, and I'm the Regional Director here at the Pace University Small Business Development Center located in Lower Manhattan. And welcome from New York City, and if you're joining us from other parts of the state as well, really welcome, and hopefully you'll get a great deal out of the session. We're really looking forward to it. As Renee had mentioned, our services are focused on both supporting new businesses as well as the launch and expansion of existing businesses here in New York State. There are 22 centers located throughout the state in our SBDCs, and I'm joined today by my colleague and business advisor at our center, Greg Callender, who is taking lead on some of these issues that we'll be discussing today from our center at Pace. Our focus is on one-on-one business advisory services, some of the key issue areas we work on a day in and day out basis, focusing on access to finance, looking at marketing and sales strategies for your business, procurement opportunities, thinking about how to build and grow in that area, and organizational structure and different accounting issues that you may be looking at, whether you're an existing business or whether you're looking to form your venture. So these are all services that Greg and our business advisor colleagues here at our center, as well as located throughout the state, all offer at no cost to you. So in a moment, I'll drop a link in the chat for you if you're interested in working with a business advisor from our center or from one of our sister centers throughout the state. Please do complete that form, and we'll be able to connect with you and get those services started right away. I'll also put a link in the chat for any follow-up questions you might have in terms of one-on-one business advisory service, other issue areas that you may be having with your business, so we can be able to build and support your efforts as you build and grow your business as well. So the one-on-one business advisory is really kind of our bread and butter, but we're also really looking at helping generate a wide range of training programs and inviting industry and subject matter experts such as today's session that Akshay will be leading in just a moment. I'll introduce him in a sec. So, if this is of interest, and we have some other sessions on accounting and other topics coming up in the weeks to come, and we've already started talking about some New Year's programming as well. So whether you're interested in programs that our center is offering or any of our colleagues from throughout the state, we certainly would encourage you to take advantage of those and join for subjects, issues that you'd like to kind of pursue. And finally, obviously, we're working on kind of support and have for the last, 2 years and some, helping small business owners with a wide range of pandemic recovery programming. There are some programs that are still out there that are accessible for small businesses that are available through the federal and state governments, as well as here in New York City, as well as a range of private sector and foundation grants. If these are issue areas that you're interested in, again, please do contact us. We're happy to work through programs that might be relevant to you and help you connect with valuable sources of financing for your growing or new business here in New York State. So with that, that's kind of a breakdown in terms of who we are. Again, I really appreciate you all joining us today. And with that, I wanted to introduce today's speaker is Akshay Shrimanker. He's a CPA and the CEO of his own business, Shay CPA PC. And again, sort of a very sharp guy and really kind of an industry and subject matter expert on today's topic, which is tax accounting for tech startups. And really looking forward to your remarks and to your presentation, Akshay, and I'd like to turn the floor over to you. And thanks again for leading this, and Nina for your support and helping pull this together as well. And of course to Greg. Thank you, Greg.
Thank you, Andrew, for that great introduction. And yeah, thank you, Greg and Nina and everyone else who's supporting today's session. Hello, everyone. As Andrew just mentioned, I'm the CEO and founder of Shay CPA, and today I'm going to be giving a tax and accounting 101 session for technology companies. So our firm has sort of built its reputation on helping early stage tech companies with their tax compliance, bookkeeping, financial reporting. And many of the companies that we've worked with have graduated from incubators such as Y Combinator, Tech Startups, 500 Startups. And we've also worked with many companies that have come out of incubator and accelerator programs across New York City. And we definitely enjoy hosting presentations and workshops and office hours like the one we're currently hosting. We're based out of Queens, New York, and we've been around now about 12 years altogether. So a real quick outline of the presentation, what I was going to talk about today. So I thought I'll start with some tax implications of legal entity selection, and then we'll talk about some Delaware tax implications, because that is something that many tech companies are impacted by. Some practical tips for first-time founders, and then we'll talk about startup expenses and financial statements. We'll next talk about R&D tax credits, and how that relates to financial statements, and then we'll get into a little bit of the accrual-based financial statements that many tech companies have to report on. And then finally, I thought I'd just talk about some of my experiences working with first-time founders. So with that, I'll get started. Based upon the attendee list that I was given, I understand that many of you are already in business and some of you are not in business yet. So some of this information may be things that you have already gone over, either in a legal workshop or a prior or just prior business knowledge. And for some of you, this will be completely brand new. So I thought, first of all, just to talk about sort of the different structures that you can create your technology company with. The four main ones that we generally see are either a sole proprietorship or a single member LLC, or a partnership where you start the company with co-founders. And this could be organized either as a partnership for tax purposes or a multi-member LLC. The third one here is an S corporation, and that has specific tax attributes, such as it being a pass-through entity and the officers having to take reasonable compensation. And then the final one being the C corporation, which is probably the most popular tax structure and legal structure for a technology company. So let me continue here, and we'll just go into a little bit of the details. So with a sole proprietorship, for tax purposes, it's rather straightforward to set up. All you pretty much need is to apply for a tax ID number with the IRS. From a legal standpoint, with a sole proprietorship, the biggest drawback is that you have unlimited liability which typically means that if there's a lawsuit or if there's any type of product malfunction, or it can come back to you and your personal assets as the owner of the business. From a tax standpoint, it's probably a very straightforward way to file your tax return. Many of you may have already be familiar with filing a 1040 on an annual basis. And as a sole proprietor, what you would typically do is report your income and expenses on a form Schedule C that gets attached to your personal tax return. And that way, you don't have to file a completely new tax return for your business and a separate one for yourself as an individual. So I think the sole proprietorship structure early on in your business is a good way to get going. But there are some drawbacks such as unlimited liability, and another big one is usually commingling of funds, which means that you may be using your personal bank account, your personal credit cards, where you have both business expenses and personal expenses running through them, and it's sometimes difficult to separate your personal expenses and wages from other sources from your business. And for this reason, it's always good to sort of practice to set up a separate bank account. So that's the first structure. The second one, LLC, which is very popular. There's sort of two flavors here. There's one which is a single member LLC. This is for the sole proprietors. So this is sort of one level. It's very similar to being a sole proprietor, except you now have an actual entity structure, that sort of a legal entity that protects you. But from a tax standpoint, it's the same filing. You would have a Schedule C form that gets attached to your 1040, and you would report your income and expenses. And it's considered a disregarded entity, which is filed with your personal return. The thing that's with a sole proprietorship and the single member LLC that's very flexible is that when your company is making money, you could take money out of the company without really too much in the form of having to actually formally put yourself on a payroll system, and you would be paying estimated taxes. So I think from a simplicity standpoint, usually a single member LLC or a sole proprietorship for solo founders is usually a good way to just get the ball rolling. But if you do have co-founders, then you would be filing your taxes as a multi-member LLC. So this is ideal for partnerships. You would be reporting your taxes on a federal form 1065, and each partner's income and losses would be reported on a schedule form K1, which is kind of like analogous to a W-2 form that you may be familiar with if you've been an employee. But instead, this is a form where you, as a business owner, would be receiving your tax attributes. So this would be your income from your share of the income from your business, or the loss from the business, if it's not making money, and any distributions or owner's draws that you've taken from the company. So this is another basic structure that many of you may be already familiar with. The third one is a S corporation. A couple pros and cons here. This is taxed very similarly to a multi-member LLC. It's taxed as a pass-through entity, where essentially you as an individual again receive a K1, and you pay taxes at the individual level, similar to the multi-member LLC. And the con is that it's only US residents. So if there are any foreign founders on the line, this wouldn't count for you. And you cannot have more than 100 shareholders. So this requirement's usually not the most practical for tech companies that are being set up for funding. This form, the tax form that you'll be filing annually, is a federal form 1120S. So this is where you would be reporting the income and expenses of the S Corp, and then each partner or each shareholder, I should say, in the S corporation receives a K1, where they would then report the income and expenses from that business on their personal 1040 tax return. So the fourth entity type, which is the most common with technology companies, is a C corporation. Currently the tax rate is 21%, and again, there is limited liability protection. There's no limit on the number of shareholders, and there is sort of two classes of shares, which are common and preferred class of stock. The sort of drawbacks here is that there is a double taxation. So if the company makes a profit, the entity is taxed at that 21% rate, and then if there is distributions, then the shareholders have to pay taxes on any dividends that the company takes. The income and expenses are reported annually on a federal form 1120. There are no K1s that get issued typically for a C corporation. So for companies that are looking for VC funding, this is usually the most practical way to set up your company and organization. So I'll talk about like when it makes sense to sort of have each entity type from a sort of tax perspective, although there are sort of legal aspects to this as well.
One quick clarifying question
sure.
there. Can you elaborate on what tax like a pass-through means?
Yeah, sure. So to be taxed as a pass, so essentially what that means is that the business itself, whether it's a multi-member LLC or S corporation, doesn't have a federal income tax liability. However, the shareholders who own that business do. So any income or losses that the company has on an annual basis gets broken out based upon the shareholders or the members' ownership stake in the company. So let's say there's two partners and they have 50-50 stake. And we'll just give a simple example. Let's say that the income at the end of the year was $100, then each partner would have $50 each of income. So the company wouldn't pay tax on that $100 of income. Each partner essentially pays taxes on their share of that income on their personal tax return. That's not to say that pass-through entities don't have to pay any taxes. Typically, there are some state taxes that are owed, but from a federal perspective, most of the income is all of the income, I should say, is passed through, or the losses are passed through to the shareholder, and then the shareholder would then, on their individual personal tax return, typically pay taxes. If they are organized as a company, they would then have to report that income on their company's tax return. Hopefully, does that clarify?
I think so. If there's any follow-up, I will let you know. Thank you.
Perfect. Yeah, and then the other
Shay?
entity. Oh, yeah, sure.
Hey, this is Greg Calendar. Just a quick question. We work with a lot of clients who may get started as sole proprietors, but then for a variety of potential reasons may feel it's in their best interest to convert to an S or an LLC. And I was wondering if you could tell us, are there any tax consequences associated with converting from one form of business entity to another?
Yeah, great question, Greg. Yeah, there are tax consequences for converting from one entity to another, and depending on a company's specific fact pattern, those consequences would be slightly different. But just to sort of go over a common one that we typically see. Would be like a single member LLC or a sole proprietor converting into a C corporation. What we typically see there is that especially for tech companies, typically we see the company has already been incorporated, let's say as an LLC in the state of Delaware. And then if they want to convert that into a Delaware corporation, there is a couple of methods to do that without starting completely from scratch. And depending on how much in earnings the company has retained within the entity, there could be certain tax implications when the actual conversion happens. Typically, with the companies that we work with that are just at the R&D stage and are just getting started, there typically aren't many tax implications. And there's usually a statutory conversion done where the Delaware LLC is converted into a C corporation. And as long as all the income and losses have been passed through to the shareholders, the prior shareholding and the prior organization, there wouldn't be any major tax consequences now for the new entity. That being said, however, one of the most popular tax attributes that many technology company founders are interested in is something called qualified small business stock. And usually to be eligible for qualified small business stock capital gains exemption, you need to have stock that's issued to you in original issuance, which means that it usually can't come over from a conversion or from a prior entity, or you can't be buying the stock from a prior shareholder. So that's why this question is very nuanced, and depending on the exact fact pattern, there could be a certain way that you want to go about doing the conversion. But yeah, so that's one. Another one that we typically see is sort of LLC, a sole proprietor just going over into a single member LLC, and that's typically pretty straightforward. But yeah, hopefully that helps, Greg.
Thank you for that. Yes, thank you.
Yeah, and then I guess the final entity type here, and for some of the organizations here that may have more of a social cause, you may want to be setting yourself up as a not-for-profit here. So generally here, there wouldn't be any income taxes. You would have to file a Form 1023, which is a application with the IRS where you are essentially requesting a recognition of exemption, so you're not subject to any income tax returns. This is governed by, you are not subject to any income tax. You're not governed, this is governed by subsection 501c of the IRS tax code, and you typically file a federal form 990 or a 990EZ on an annual basis for your not-for-profit. For most of the tech companies we work with, this isn't usually the profile they set up in, but it's not uncommon for a company that may have a social cause to be a tech-enabled platform that wants to go down this route of setting up its organization. So that's why I thought I'd bring it up. So what we typically see for most early stage tech companies is that they would generally set up as a Delaware LLC or a C Corp. Now, the reason why Delaware is the state that's chosen, many of you here in the Pace SBDC may be residents of New Jersey or New York or the tri-state area, and you may be thinking, why Delaware? I think the simplest way I could put it is like I almost think it's like the lingua franca of the way the attorneys work, in that they understand the court system there. It has a very business-friendly structure, so you can set up your company there. There's certain privacy rules, and for that reason, many companies are set up in the state of Delaware. And just as a practical matter, most VC firms and angel investors won't invest in your company unless it's incorporated and set up in the state of Delaware. What this means is that from a tax standpoint is that your company would have an annual filing requirement, which is a tax return essentially that needs to be filed with the state of Delaware. And there's a nominal tax that you would have to pay there. Depending on how much fundraising the company has done and money that's been invested into the company, there would be sort of a graduated tax system where you be paying tax on the amount of assets that the company has over time. What this does mean from a practical standpoint for New Yorkers is that if you want to do business in the state of New York or the state of New Jersey and set up an office there, you have to go through a process where you set up as a foreign corporation doing business in the state of New York. So foreign from the standpoint of you're a foreign corporation from the standpoint of New York, but you're really a Delaware company doing business in the state of New York. So this nuance has some tax implications in that you have to now file not only in Delaware, but you have to file New York state taxes and along with your corporate tax return on an annual basis. From a practical standpoint, when you're just getting started as a first-time founder, I found that a Delaware LLC can be practical because if you do end up going down the route of fundraising and attracting investment from outside investors, then there is a slightly more straightforward process to convert that Delaware LLC into a Delaware C Corp. And I think it's ideal really for solo founders. So if you have co-founders, then I think the Delaware LLC, it still works. But I think you may as well just skip to the C Corp at that point. The main reason to do the LLC is really a couple fact patterns. So one is, let's say you are a founder, you've just started your company and you're bootstrapping, which typically means you are investing your own funds. So let's say you have a W-2, you have a salary job and you're moonlighting, you're doing this on nights and weekends just to see if you can get your idea off the ground. You may be investing a lot of personal funds and time into just getting the business off the ground. When you set yourself up as a LLC, what you can do is very often from a tax standpoint is some of the expenses from your business can help offset your other income. So if you earn wages or if you are married and your partner has wages, some of the losses that your business may earn may help offset other income that you may be generating. So from a practical standpoint, early on, it can help. But this needs to be carefully thought through whether you want to go down this route. And it's good to speak to someone such as myself or an attorney just to get context whether that type of setup works, or does it make sense just to go straight to and set up the Delaware C Corp when you're getting going. The other thing that's very unique for technology companies is this concept of 83B election. This may be something that you may have heard of before or have heard in a legal lecture. But essentially, this is the mechanism where you are purchasing your founder shares and you are entering into a restricted stock agreement. So typically when founders set up a tech company and they set up a C corporation, they will be purchasing the stock in their company. And when you do this, you typically have a restricted stock agreement where you are not receiving all your shares up front. You typically receive the shares over time. The typical length is a 4-year vesting with a 1-year cliff, which means that if you or your co-founder leaves within that first 12 months, you sort of leave with nothing. At the end of each year of vesting, you receive 25% share of your total stock. And the importance of the 83B election here is that once you sign your founder agreement, you typically have 30 days from that date to file this form with the IRS. It's something that needs to be sent through snail mail to the IRS office where you file your tax return. And so it's a very archaic mechanism, but if you don't do it, there is some pretty severe tax consequences. So a couple of tax consequences if you don't file the form. If you don't file the form on time and let's say a year from now you attract outside capital, the shares that are vesting over time are now no longer at a very low or nominal value. Your shares now have a higher value, and essentially you would have to pay taxes on the difference between the value that you bought the shares and the value that the shares are now worth, even though those are typically, it's really not something that's realizable at that moment. So this is like a common foot fault that I see founders sometimes make in not either filing their 83B elections on time or not thinking about putting a restricted stock agreement in place. So working with a good attorney and a good CPA at the beginning is really important, just to avoid some of these common foot faults. Let me just pause there. If there's any questions about that, or anyone has any, just want to check if any questions came in, or clarifying questions came about that.
We're in good shape right now.
Cool. All right. Well, I'll keep moving along. So yeah, I think just some practical tips for first-time founders. Like some of you, have already got going with entities. You're organized as LLCs and C Corps. But for those of you who haven't, as I was saying, I think like a sole proprietorship or a single-member LLC is probably the most efficient structure. From a tax standpoint, it's pretty straightforward. You just attach a Schedule C to your personal tax return. I know if any of you have ever received a 1099, either as a freelancer or if you've done anything in the gig economy, then you may be a little familiar with this process. As I said, it's easier to sort of write off expenses, but it's always good to open up a separate business bank account to just avoid commingling of funds and just to organize your information, especially when it comes to tax time. I thought this would be a good slide to go over because it would just sort of give you a sense of like, because a common question I encounter, especially with first-time founders and also with founders that are student entrepreneurs, is like, when should I get organized as an LLC, or when should I incorporate? And I thought this would be a good sort of flow chart just to sort of show the steps. So I think like if it's just you and a buddy in a garage and you're just thinking about ideas and it's very much at the product ideation phase, then I think either a sole proprietorship is fine for that part of the company's process. Building an MVP, which is sort of your minimal viable product, I think a sole proprietorship again, or a partnership at that point is fine. You don't have to get fully formal. And I think this is more true for first-time founders than maybe like someone who's already had an exit and is now starting a business again. For those founders, there may be other implications. And also, if you are someone that may be going through a graduate school program or a PhD program where you may have access to the college's resources, in that case, you may need to incorporate earlier. I think running a pilot or a test is probably the first time where you want to start thinking about organizing in a legal structure, because at this point, you're going to be interacting with either customers, users, and at that point, you open yourself up to liability. So at this point, depending on how large that sample size is, you may want to think about organizing your entity into a LLC. And for others, maybe even a C Corp. But very early on, you may be able to make, just on the fly, just do the pilot as a sole proprietor and take that risk. And it's something that I've seen frequently, and you're kind of from a legal standpoint, probably attorneys would hate me saying this, but you kind of are taking the risk in a lot of ways. But when it's so early on, you may not want to spend the money to get incorporated, and it may be worth it. When you start invoicing your first customers, again, like you could do this just as easy as a sole proprietorship or a single member LLC. Again, another key aspect here is when you start hiring subcontractors or want to get payroll organized, I think at that point, really, you should be setting up a LLC or setting up a C Corp if you're going to be going down the VC funding route. And then I think revenue milestones is another big one to think about. So if you start hitting 5K a month, 10K a month in revenue, you really need to start thinking about organizing and incorporating your entity at that point. If your entity the first year is making no money, there's no money in, and it's just all money going out, the LLC, the single member LLC may be a good thing to set up depending on how much money is going out. So some entrepreneurs, especially student entrepreneurs, sometimes they fall into the trap of incorporating too early, and before you know it, they graduate and then they go out for a full-time job, and they have this sort of corporation that's sort of hanging around them, and they have to keep filing taxes for and go through all the legal process. So depending on where you are in your journey, you want to think about what type of entity makes sense for you and your co-founders at that time. So I thought this would be a good way for you, a framework for you to maybe think about it. So I think, when you do have paying customers, you want to start thinking about your accounting systems. And I think for bootstrapping startups, there's some simple systems that you could use. So Wave Apps is a very popular one that I recommend to companies that are bootstrapping. They have a freemium product where you can connect your business bank account, it'll bring in all your business transactions, and you can easily sort of keep track and categorize your expenses in a uniform way. If your company is starting to bring in some significant revenue, then I think QuickBooks is really the standard. There's another product, Xero, that's out there as well. And there's a few others here that I've mentioned, like FreshBooks, which is another popular one, and Stripe, which is also another invoicing sort of platform. Not really an accounting system, but more on the invoicing side. Other payment systems that I'm just going to mention here are Venmo and Cash App. I think early on, especially when you're just sort of doing your pilot, you may want to use simpler payment systems where you get cash in a lot quicker. And as I was mentioning earlier, it's always good practice opening up that separate business bank account for your business, just to separate the funds from what you do personally to what you are doing as a business. So next, I want to talk about what is a tax deduction and how the IRS defines this. So the IRS defines a tax deduction as anything that's ordinary and necessary. So just to give sort of an example, like for a car rental company, let's say it's a luxury car rental company, an ordinary and necessary expense may be buying a luxury car, a BMW or a Lamborghini or something like that. But for a tech startup, an ordinary and necessary expense is going to be more something like software subscriptions to like AWS or Google or Zoom, and not necessarily buying a luxury car. So that's how the IRS looks at it. It has to be something that is accepted in your industry and is helpful and appropriate for your business. And sort of a related topic here is how when you should be expensing versus capitalizing, that I thought I'd just touch on briefly. Capitalizing generally means that you are taking your your total cash outlays, and instead of expensing everything in the year that you spend that money, you instead capitalize it as an asset, and then it is expensed over time. So this typically happens, first of all, for equipment, such as computers, office equipment that is like, let's say 3D printers, furniture, fixtures, things like that. Those are typically capitalized as an asset and then realized as an expense over time. So you don't get a tax deduction in the year that you actually spend the money. It's more over deferred. There are exceptions to this, especially for equipment that can be expensed in the year of purchase under certain bonus depreciation and other accelerated depreciation formats, just section 179. However, that's just the general concept. The other expenses that can also be capitalized would be for research and development costs and for a startup expenses. So when your company is just getting started, you may have certain incorporation expenses, certain expenses to get started. And typically the way the IRS looks at ordinary and necessary, this means that your business needs to be an active trade or business. And when you're not active, which means when you're just getting started and you don't have anything to sell at the moment, the IRS will look at your business as one that's not really an active trader business. It's more in the research and development stage. And typically businesses at that stage need to be capitalizing their startup expenses, which means you don't get that immediate expensing of your tax deduction. So I thought I'd just walk through that, and something important to look at, especially when it comes to tax time. So just sort of like organizing, talking about organizing your expenses, I think using a spreadsheet in the beginning is probably an easy way to think through how to organize your expenses. And here is sort of like typical startup expenses. Some of you may be using your car, you may be using your home office, you may be having meals, travel, software, supplies, laptops, using co-working spaces for rent, buying business cards. So these are like typical sort of startup expenses. Some of these may be deductible in the year that you incur them, and others may need to be capitalized and expensed over time, as I was mentioning. But I think in the beginning, what you want to get used to is sort of organizing your expenses in some type of spreadsheet and creating some level of organization. So I think the first step is having a business bank account. And then from there, what's going to happen is you want to have some type of a folder. If it, previously people would have physical folders where they organize their receipts. Now it's a lot easier. If you're using an accounting system like Wave, you can organize your expenses and your receipts there, or in QuickBooks. Or you could set up like a Dropbox folder or a Google folder, a Google Drive folder, and organize your receipts and your initial cash outlays in a simple way there. So I thought I'd just mention sort of how to organize and just some best practice tips there. Just to get into the weeds a little on the startup expenses. So business startup costs are amounts paid for creating an active trader business. So typically these expenses would be recoverable over a 180-month period, which is 15 years. So if you do have initial startup costs, let's say you pay out for legal expenses and other initial costs, those typically get capitalized and expensed over 15 years. So just something to take into account when it comes to those initial expenses of just getting going. And what's typically considered a startup cost is something that a business could deduct if they paid or incurred to operate an existing active trader business. So any type of sort of legal fee or accounting fee, even travel and payments to contractors could be considered startup expenses. And typically the way the IRS looks at this is once your website or your software is actually active, which means that like it's publicly facing, people can come to your site, they can use it. Not necessarily that you have to have revenue, but you need to have users or some type of audience for the IRS to really look at your business as a active trader business. If everything is just sort of happening in stealth mode, then it's typically going to be considered under this section 195, where everything is considered a startup expense. So just some more examples here. So we have some surveys, advertisements, marketing, salaries and wages for employees, travel, even payments to executives and consultants could be considered part of this capitalized startup expense area. So that really concludes the sort of the tax area, and I thought I can go into now the financial statements. So just to talk about this, and I believe some of this is going to be covered more in depth in another session, so I'm just going to briefly talk about the financial statements. So the three main financial statements are the balance sheet, the income statement, and the statement of cash flows. The balance sheet is what has your assets, your liabilities, and your equity. And the equity part of tech companies is a very complex area that consists of common stock, preferred stock, and stock options for your employees and advisors. This is something that will probably be covered in a separate legal workshop, but I think this is one area where startup founders have to take a lot of do a lot of research and work with their accountants and legal advisors on, as this is really the heart of how you fundraise and the way that the company is actually going to be capitalized. So there is some complexity in the accounting and tax implications there. I'm not going to cover that here, but happy to take sort of follow-up questions, and we could probably even set up an entirely separate workshop for that. The income statement, this is going to be showing your revenue, your expenses, your net income, and your bottom line, which is your net income or loss. Many tech companies, when they're just getting going, they're typically showing losses on their income statements early on. And then the statement of cash flows, this is really showing your operating activities, your investing activities, and your financing activities to get from your beginning cash to your ending cash. And there are different methods to create a statement of cash flows. So that's just a quick overview there. So next, I wanted to touch a little on financial modeling. So this is an area where a lot of early stage tech companies spend time on, especially at the initial stages, because you're essentially going to be using assumptions to project out your sales, your gross profit, your margin, your expenses. And very often the fundraising that your startup is going to receive in the beginning is going to be underpinned by your financial model. I typically recommend founders treat this as a living, breathing document instead of just sort of tucking it away in a drawer once you complete your fundraising. And as you build out your team, so this is more now for the folks in the audience that may have already incorporated, you typically want your financial model to be owned and driven by the different members of your team. So if you have a VP of sales, they will take over your sales projections. If you have a CTO, they can help you with projecting out what your dev team and your product team, what those costs are going to be. So just want to quickly touch on the importance of financial projections, and I believe that's also another session that needs more in-depth analysis on, but I thought I could just quickly touch on. I'm just going to skip through these drivers and talk about this financial summary. So this is a quick summary here that I often help founders sort of put together when it comes to just projecting out their actuals and then projecting out their forecast for future quarters. And this is sort of a typical snapshot that is provided to maybe some early stage investors or angel investors who just want to understand how the company is doing now as far as the cash on hand, the revenue that it's incurring, the expenses that it has, its headcount, and what you project it out to be in the future. And if you have a good financial model put together, you could put together a financial summary like this that gives investors confidence in how you see your startup developing from a financial standpoint. So the other thing that I want to mention is your finance tech stack. So as I was saying earlier, QuickBooks is sort of the platform that most of our clients use. When it comes to payroll, there are quite a few solutions out there. Gusto is very popular beyond like ADP and Paychex. There are multiple vendors that you could use, but I think Gusto, JustWorks, TriNet, they all do a great job, especially with tech companies. When it comes to bill payments, there's so many spend management platforms now like Brex and Ramp. Bill.com is a very popular one for segregating duties once you start building out your finance team. And expense management, as I said, Ramp, Brex, Expensify is another big one as well. I was mentioning earlier about your cap table and equity, and I think a big thing here is your capitalization table, and the big player in that space is Carta. So just a few tech solutions I thought I mentioned who can help as you start thinking about how to put together your finance tech stack. And these are sort of the different providers that we see come into play, depending at which stage you are at. If you're at the super early stage, you may only need QuickBooks or you may only need a spreadsheet. But if you start now onboarding customers, employees, and bringing in investors, you'll start having to develop out your financial tech stack. And I thought I'd just go over how some of that would be visually seen. So next, I'm going to talk about revenue, and especially as it relates to tech companies, as they are typically on the GAAP and accrual basis of accounting. With revenue recognition, you can either be on the cash basis or on the accrual basis. On the accrual basis, you're typically on tracking your revenue as it's earned instead of when the cash is actually deposited into your checking accounts. And on the cash basis, you're only basically keeping track of deposits as they come in. So a few tools that you could use to sort of keep track of revenue, especially for tech companies, is Stripe and Square. They're usually the two that do a lot of the actual billing to customers. For companies that may be more in the enterprise space, you may be wanting to use your accounting systems, so QuickBooks or Xero is fine for that. And as far as just sort of making sure that you're organizing your information, using your financial model is the best place to sort of keep track of how the revenue that you are earning, it relates to your actual projections. So you want to keep track of actuals to projections at all times as well. So I mentioned startup revenue recognition here. So I'm just going to skip this slide and talk a little bit about MRR, which is monthly recurring revenue. So with monthly recurring revenue, what this essentially is, and I'll just give a better example, which is here in the next slide, is essentially the normalization of your monthly revenue. So if you have 5 customers that pay you $50 per month, your MRR is $250. However, for accounting purposes, generally the MRR is not something that is put on financial statements. Typically on financial statements, we are dealing with deferred revenue, which essentially means if someone pays you upfront, so we have an example here. If you receive $1,200 for an annual contract starting in January, that revenue at the end of January will be equal to $100, and the deferred revenue will be $1,100. So on each month, you would be recognizing $100 of revenue instead of showing the entire $1,200 upfront. So just wanted to show the nuances between sort of MRR and deferred revenue. And ARR is annual recurring revenue, and this is essentially the normalization of annual revenue. So if a customer pays you $5,000 for a 2-year contract, the ARR would be equal essentially to $2,500, which is splitting that 5K into 2 years. So let me go into the next slide. I do realize that we're running short on time, so I just want to make sure I'm cognizant of any questions that are coming in.
We're in good shape right now. We have a few for the Q&A, but no clarifying ones right now.
Okay, cool. Let me just see. This session runs until
1 o'clock?
1. Okay, great. So I think we have 6 minutes left. So should we open it up to Q&A?
Sure, and you can wrap up the slide too if you want.
Yeah,
and I'll
sure.
let folks know if you do have questions to jump into the questions box right now, and I'll start organizing them.
Perfect, perfect. Yeah, so I believe a copy of these slides will be made available. So yeah, if there's anything I missed, feel free to review those, and then I can we could kind of follow up if you have questions. But this slide here is really talking about deferred revenue again, and the nuance being here that tech companies generally have to show that revenue being recognized over time, and they have to capitalize and show that as a liability on their balance sheet. And as that service is performed, they recognize it over the time on their income statement. So yeah, just thought I'd go over that, and yeah, I guess we can probably open it up to Q&A.
Very good, thank you. Andrew, did you have a comment while I get these organized?
I did a few actually. Akshay, thank you so much for the presentation. I thought it was really, really insightful for businesses at varying stages, as that's kind of who we meet with on a day-to-day basis. I wanted to sort of to highlight a couple of things that kind of jumped out at me in terms of your comments that I'd like to reiterate is starting to sort of formalizing your operations. I think sort of separate, setting up a separate bank account as an example, I think is a really good one. We work with a wide range of community-based lenders. So if you're here in New York City, a number of credit unions and other kind of solid community-based organizations can also serve as a prospective entree in terms of kind of getting your business more formalized. So I really appreciate you kind of highlighting that. Talking about kind of the minimum viable product and kind of identifying customer demand. I think so much of what we work with on a day-to-day basis is focused on making sure that your widget, whatever that may be, kind of there's a demand for it. I think being able to focus on kind of formally defining what that is and assessing what customer demand is out there, I think was really, really insightful and helpful. And certainly something that business advisors are going to want to kind of talk through with you to make sure that you can kind of well define that, whether it's through a business plan or other methods to make sure you can kind of best describe kind of who you are and what you're doing. The invoicing aspect, I thought you had some amazing resources, and certainly we would encourage attendees today to kind of take a look at the different opportunities about how to kind of be formal in your efforts. If you're generating revenue, make sure you're invoicing and having this be kind of part what you're doing as a business owner. And organizing your expenses and tracking receipts, kind of this formalized effort, I think is something so crucial, and certainly something that our advisors deal with on a day-in, day-out basis. And the last item, I guess, that jumped out at me, obviously, was the financial modeling and developing projections, being able to work through how things are looking for you as a business owner, and what kind of growth you want to be able to project to prospective investors or partners or other key stakeholders. So crucial and definitely kind of a key area that our business advisors like to work on as well. So I don't want to take up any more time, but it's a couple of things that jumped out at me, and thank you so much for highlighting that as part of your presentation.
Absolutely, thank you. And you are correct. We will be sharing today's slides and the recording shortly after the presentation. It takes about 3 hours to hit your inbox, and it will be coming from GoToWebinar. And if you have any questions for the Pace team, you can just reply to that email and I'll go directly to them. Jumping back to the Delaware situation and filing there, which is ultimately better, filing in Delaware or New York City, or is it really a preference of the founder?
Yeah, so I think it's got to do with the situation that the founder is in. So like myself, I'm an accountant. When I started my firm, I had no ambitions to really fundraise or generate or attract any investors. So I incorporated as in New York State. So if you're going to be a small business or a solo company, I think incorporating in New York is fine. I think for doctors, offices, lawyers, professionals, many of us, that's the way we have to get organized. For tech companies, the nuance becomes whether you're going to be looking for that outside capital. If you are, then incorporating in Delaware is sort of needed by default. However, one thing I'll say is we've worked with companies in the past where the day that they got their funding was the day they got incorporated in Delaware. So you can always do that. You know, if you have a product that is compelling or an idea that's compelling, this formalization can be done later if need be. But yeah, that would be my tips there.
Thank you. Well, you answered so many questions throughout. That was the only lingering one to clarify on. Greg, did you have any questions? Or Andrew?
Actually, I did. Shay, I have a question for some of our tech entrepreneurs who may own intellectual property, say a patent, on an individual basis. They file and they own it as an individual, but now for business purposes are considering moving that IP into some sort of a corporation, LLC, S Corp, or what have you. I was wondering if you could speak to whether or not any tax implications associated with that, and or any other sort of advice in terms of the timing for a tech entrepreneur who, again, individually may own some intellectual property, but for business purposes, for attracting capital purposes, is interested in moving that intellectual property into a corporate structure.
Yeah, that's a great question. So with intellectual property, the way that we typically have seen that in the past is either the shareholder, when they either are going to assign it to the new corporation as an asset, or they can license it to the company. So if they assign that IP to the corporation as an asset, typically what they'll do is whatever sort of resources went into creating that IP will be assigned a value, and that value would typically be shown on the balance sheet as some type of equity contribution from that founder of that IP for the value of that IP. So that could be a very nominal value, or it could be very significant. And where we've seen that in particular is with founders that have worked with either research institutions or with colleges and universities, where they've used the resources of that institution to develop products or to develop ideas, and now they want to transfer that into a new entity or a new structure. And typically there you would have to go through the university's tech transfer team and their department to work through the agreements to make sure that things are done the right way. If it's a licensing structure where you as the founder are getting paid something in addition for contributing this capital to the new entity, then there could be some tax implications there. So it just depends on how you are setting that up. It would trigger a few different tax consequences.
Thank you.
Very cool. Thank you. When I do shut down the webinar, it is going to prompt you to complete a survey. If folks have any additional questions that they have thought of after we shut down, feel free to put them in that survey and the Pace team can follow up. Or as I mentioned, you can reply to the GoToWebinar email and that will go directly to Pace. Thank you so much. Are there any final words, last words for folks before we shut down?
Well, yeah, I want to thank Andrew, Greg, and the whole Pace SBDC team. I feel like there's so much to talk about in this area, so happy to come back and go more in depth into a particular topic or space. But thank you all.
Absolutely. There was a few slides there that you mentioned could be presentations on their own, and
Yeah.
Andrew will take you up on that, I promise.
Yeah. Thank you very much. It was a great session. There really was so much there. I think a lot of really very insightful takeaways for the range of entrepreneurs and small business owners who are attending today. So really appreciate you leading this session for us and for your time and efforts. And thanks very much. And Renee and Jenny and Nina, Greg, all of you, thank you very much as well. I really appreciate it.
Absolutely. All the questions on the survey are optional. The ones we look forward to the most are the ones letting us know how today's session went and any future sessions you would like to see. Take care, everyone, and we will see you next time. Bye-bye.